Hi, I'm Whitney Espich, the CEO of the MIT Alumni Association, and I hope you enjoy this digital production created for alumni and friends like you.
Hi, welcome to the MIT Social Entrepreneurship Alumni Group webinar, Conversation about U.S. Impact VC Landscape. I am Sayuri Sharper, President of the Alumni Group. I'm pleased to have as our guest Miles Lasseter, founding partner of Purpose Built Ventures, where he invests at the earliest stages in companies working to increase impact. He's also the host of the Startups for Good podcast and blogs at venturepatterns.com. Miles is a company founder turned investor. Miles co-founded Hire One while in college at Yale and grew the higher education fintech business to over 200 million in revenue and 1 billion in market cap on 16 million of venture financing. He served variously as chairman, president, and COO, including leading product, technology, operations, and marketing. Miles went on to start 2 other venture-backed startups, including SeeClickFix, which is a SaaS for local government, and OneUni, higher education via smartphone. What an impressive background. Today's event is an interactive conversation with Miles. I'll start with a set of questions, then take questions from the audience. My question will take about maybe 15 minutes, so the rest of the hours is for you to enter your questions. So those questions that you have, please enter them using the Q&A function. And at any time during this hour, and my co-host Vera will be reading them out and helping with the Q&A session. So let me start with just a few words about our organization. MIT Social Entrepreneurship Alumni Group. We are organized under MIT Alumni Association, and our mission is to bring together MIT alum and like-minded people to co-create a better world through social entrepreneurship and impact investing. We welcome anyone who is supportive of our mission and invite all interested persons to join our community platform. So what do? We organize webinars and other programming to share, learn, and support each other's journey. Our next webinar scheduled for next Friday is conversation about India Impact VC Landscape. You can see our URL on this slide. Joining the community is the best way to stay informed about our activities. So please check it out. If you have any questions, you can contact me at sharper@alum.mit.edu. Now let me introduce Vera Schroeder, SEEG's VP of Programming, who is not only my host, but has an exciting upcoming program, SE Lab, to share with you. Vera?
Thank you, Sayuri. So Harpreet and I launched a more hands-on MIT SEEG program called SE Lab, Social Entrepreneurship Lab. It's a typical entrepreneurial lab, but focused on entrepreneurs in the social impact space. It's a 6-month program starting in February of next year, ending in July. For the founders, it's around a 4-hour commitment. We offer mentorship, expert classes, and cohort engagement. If that at all sounds interesting to you, I'm going to put the link to the program in the chat box below, and I'm also going to put the application link in the chat box. Looking forward to having you.
Thanks, Vera. Let's get started. Miles, thank you for joining us today. You're on mute right now, so maybe, yeah, you're all set. So let's get started with you're telling us a little bit more about your journey from being a serial entrepreneur to an impact investor.
Yeah, so thank you so much for having me. I'm excited to join you today. I've been a part of MIT Enterprise Forums in the past. When I was just starting out as an entrepreneur, we pitched at the New Haven chapter. I started 3 companies, as you mentioned, and really still take the founder perspective, even now that I've transitioned to an investor. I've always been involved in helping other entrepreneurs. When I was an undergraduate and when I was an alum at Yale in town in New Haven, helped start the Yale Entrepreneurial Institute, which has now morphed into Yale's Sci Center. These opportunities, as well as informal mentorship, helped me stay in touch with the early stages, to meet incredible people and understand where the future is headed, which is such an exciting privilege. I realized I was doing it as a hobby and for fun as I was a founder. And I figured, why not make this official? And I went in search of the secret knowledge, right? The learning that would tell me how to be a great investor. I joined Kauffman Fellows, for example, talked to a lot of VCs, and I've realized that there's no one thing that I'm going to learn, that's going to make me a great investor. There's a series of skills, there's a series of habits, and there's a series of sort of behavioral patterns that you need to develop. Thought ways of thinking. This is both mental models, but also habits of mind that I think help make you a successful investor. So I've started on that path over the last few years and continually every day trying to get better at it.
So what does Purpose-Built Ventures do? How are you different?
So I take the perspective of a founder, and we take the side of a founder, which is not unusual in today's VC landscape. We also focus at the earliest stages. I've been first check into certain companies, like to be when the first $1 million raised or so. Tech-enabled companies of founders that are mission and impact oriented, but intend to raise VC over time. So they're committed to both high values and high growth, which is really a subset of both social entrepreneurs and a subset of traditional entrepreneurs. And in this narrow sliver, I think there's incredible opportunity not only to solve big problems for the world, but also to make a lot of money. So I'm interested in entrepreneurs who are not ashamed to say, I'm doing good and I'm going to get rich.
That's a great goal. So in your mind, what is the difference between impact VC and traditional VC?
So I think it's a continuum. And I think there's constantly sort of new terms that are coming up because sometimes terms can get stigmatized or begin to mean different things to different parts of the market. I think that it has been evolving, but your traditional VC limited partner investor, that is the folks that invest in VCs, I think only very recently are becoming open to the idea of impact or mission-driven venture capital. You're starting to see over the last year or two, perhaps, Cambridge and other advisors to these LPs start to track the category and show that the returns can be great. You're starting to see some openness to it and some understanding. I would say prior to that, the real assumption was that you were trading off return profits when you went for purpose or impact. And I think the recognition is coming that there are times it can be self-reinforcing and that you can have more. So I think there are different classes of impact VC. There are those that will say impact first, right? Mission first. Sometimes those are even foundations or nonprofits that are willing to invest where there may not be as much of a market, as much of a willingness or ability to pay particularly for those really marginalized populations or underserved populations who don't have money. But still, there may be a reason to have a for-profit model, but it's not going to be a huge market. Now, those investors are one class, and then you'll have some investors who are really, I would say, more traditional VCs who are looking for big markets, big returns, lots of growth, who are willing to come closer towards more traditional impact categories. You've seen some traditional VCs take more interest in healthcare, for example, or in government, civic tech type areas. And so that's one movement. And then you have an impact VC in the middle who's saying, I'm equally as dedicated to tracking returns as I am to tracking impact metrics. And in that category, I would put DBL, Double Bottom Line Ventures, for example, as an early pioneer in that space.
So, in your opinion, how if you segment the VC landscape from kind of impact focused, mission driven first versus impact and financial and pure financial, how would you say the size of the VCs are?
Yeah, I
today?
don't have great numbers on this. I apologize for that. The traditional VC landscape has been growing in terms of number of managers, dollars raised, AUM. VC managers are coming back to the market now instead of every 3 to 4 years for a fund, every 18 to 24 months. So the cycles are accelerating. So you've seen a huge growth and explosion in traditional VC in that way. And I have not seen as much growth in the mission first investing. You've seen some foundations that are, putting their toes in the water around mission related investment, program related investments. But I have seen more and more in that category that are saying both returns and impact. And I also see a growth there. So if I had to put rough numbers on it in terms of dollars, I mean, it still feels like 90+% of the traditional category.
Okay, so if you are a social entrepreneur where you focus on impact, but you think that you also have growth, how do you find the right VC to speak to?
I think getting clear about where you are in that continuum and would the opportunity be attractive to traditional VC if you don't even speak to the mission part, if you were able to tell the story purely in business terms, is an attractive business opportunity. If it is, then I think choosing the right partners at traditional VC firms who won't be anti your mission and will be supportive of it in that larger business context can work for you if you choose carefully who the particular partner is that you're involved with. If you're looking for a VC that is interested in strengthening your mission and is explicitly about impact and profit, there's an increasing number of them and they're more and more visible. I think there's been some discussion recently about, what are the effects of many VCs relying on introductions as a screening mechanism, but it still is fairly common. And that is the sort of traditional advice. If you are in the networks that can provide you, like MIT network is a great one, that can provide you with introductions to those VCs that you have selected, you can use that as entree. I would say in today's world where more and more is going digital, I've seen a real growth in forums and lists and online chat groups and websites that are dedicated to connecting investors with founders. So, I was just looking yesterday at a directory put together by One World. They have a list of impact VCs, for example, and you can find the contact information pretty easily. You can join these online communities. You can look for lists of those investors who have put out there that they are willing to take cold outreach, without requiring an introduction. And there are these lists online. So I would encourage you to use all of these types of resources.
So in terms of if you're looking for a VC, are there VCs that are more sector specific or sector neutral, and do you have any advice to kind of which type of VC to approach?
Right. I think this is a good question. And yes, you're right. There are definitely sector specific VCs. I think that it depends again on your situation and your goals. If you're in an industry or taking a strategy that requires a lot of capital, you're going to take a different strategy than if you're going to be able to be capital efficient and raise relatively little amounts of money. If you want to raise a lot of money, there are advantages to making sure you tap in, if you are able, to the biggest brand, largest VCs. And assuming that you have an attractive enough business proposition for that, a generalist VC with a good brand name can be a great way to have lots of capital. I often advise entrepreneurs that it's great to have sector specialists in that mix as well, if possible, as part of your syndicate. So, particularly at the early stages, it's common for multiple investors to be part of a round. And so you can balance those different things, access to future capital with expertise about your particular sector. If you're raising less money, it may make sense to connect with someone who really understands the problem you're trying to solve and is willing to back your solution to it. And you won't have to explain it over and over again. I've certainly heard from entrepreneurs and experienced it myself, the frustration of approaching a generalist about a particular niche or a sector specific problem and having to start from ground zero and feeling like you never get to talk about what's unique about your company because you're still educating them on the market. And that can be frustrating.
So what sectors are hot or easy to raise today versus what are cold or hard to raise?
Yeah, I think looking backwards, you can look at the numbers of which sectors are raising money. That doesn't necessarily give you a crystal ball about what's coming up. But if you look at the recent past, certainly been a lot of money still going into SaaS or software businesses. There's lots of interest this year has gone into digital health, for example, and other things that are sectors that are impacted by this sort of stay-at-home way of life that we're having now. Even sectors that you thought were not ripe for VC investment in education have seen an uptick. I think less hot would be hardware, for example, at least among sort of traditional Silicon Valley VCs, because of the capital intensive nature of it. When there were the original stay-at-home orders in March and some public market volatility, many investors pulled back, but it was very brief. The pause among early stage VCs really surprised me, how quickly people got back to business in doing deals over Zoom. And this applies particularly to seed and before, and I think later stage deals. What I am hearing from, and this is somewhat anecdotal, but what I'm hearing from my fellow investors, the Series A investment, where someone, usually this is the first time you're getting an outsider joining your board where there's serious implications to governance. It's 3 to 10 million, say, raised. It's a real institutional round where it's going to be priced. You're going to be selling stock instead of safes or convertible notes. You're going to have lawyers doing due diligence. And this is often the first sort of serious, intense fundraising experience that a company will go through, rather than more informal at earlier stages. This requires a lot of trust. And I think people are still learning how to build that trust over video chat. without meeting in person. And so I do hear that my fellow investors are struggling with that, with investing in people they've never met, and making that commitment at that Series A stage. So I would say there seems to be some slowdown, not severe, but it is impacting the Series A stage.
So how do kind of impact VC like yourself source your deals?
Yeah, I write about this on Venture Patterns, my blog. I catalog the mental models and strategies that are used repeatedly by investors and by founders. And I have a whole series on sourcing the techniques. I think impact VCs source in very similar ways to other VCs. Many, choose to make themselves visible and help, make it possible for founders to find them. There are a number of strategies like writing content, to even not as relevant these days, having parties, being well networked, being connected with universities. There's a myriad of ones, and I would encourage people to check out venturepatterns.com for that whole sourcing series. You can understand how investors are seeing the world and you can understand their behavior sometimes a little bit better.
Okay, so my last question is what are your top 3 advices to a social entrepreneur?
Well, I'd be remiss if I didn't plug my podcast, Startups for Good. Listen to there, and there are a lot of entrepreneurs who I've already recorded interviews with. There's some that have already been released, and they give advice in their own words about how to have ideas, how to pick your co-founder, how to recruit, how to incorporate mission into everything that you're doing. I think it's also really important to have a vision of success and a vision of failure. I think a lot of entrepreneurs have that vision of success, but they don't necessarily think about what does failure look like. And I found it to be extremely helpful with Hire One because we literally had a conversation and we had specific visible criteria by which we would know when it was time to stop. And if it wasn't in that situation, and we could look and say, it does not match these criteria, then we knew it's time to keep going. And it helped me put aside a lot of the dithering, like, am I doing the right thing? Should I keep going? Should I stop? Where's the line? Where's the edge? I found that as an entrepreneur, there's unfolding levels of commitment. You believe that you're committed. You think, I'm really committed. And then you realize, wait, I haven't used some resource. I haven't called upon some connection. I haven't pushed myself to some other limit. And then you feel like you're committed. And in my experience, this happens multiple times through your journey with a particular company. And then number 3, I would remind people that you can only steer once you're in motion. So I'm a big fan of entrepreneurs having a bias towards action, moving forward, moving first, doing something, getting out, trying to sell, talking to customers, starting to build the product. Only by being in motion will you see how you need to course correct. And you can't steer if you're just sitting in place, thinking about the idea and only keeping it to yourself.
Great, thanks, Miles. We've got quite a few questions that has come in. So I'm going to turn it over to Vera so she can pose these questions.
Yeah, we got a number of audience questions. If you don't mind, I'm going to start with one I have myself on the Kaufman program. Is it one that you would recommend, and what was your most useful learning from the Kaufman program?
Yes, I would recommend Kaufman. It is a powerful network, amazing people, wonderful access to ask questions to the experienced venture capitalists. I found the most important thing for me was realizing that there isn't this secret book of esoteric knowledge that would
the secret book they kept from you.
I realizing that made me a better investor. I know it sounds silly, but this is literally the process that I went through. The network is powerful, and I would recommend it to people. who can afford it, it's not inexpensive. They do have some scholarship programs. For me, I never went to business school, so I kind of considered it a good deal compared to business school.
That's a good way to look at it. All right, moving over to the audience questions. We have one from Alon. So Yuri has been asking about the entrepreneur VC process, but how about the VC investor part? And I think they mean the LP. Where do you think an impact VC can raise money? Where are the ultimate investors that focus on impact investing and are willing to sacrifice some financial upside for the impact?
Yeah, so I think this, again, depends whether you're one of these VCs who's focusing on both purpose and profit or who is really mission first. And you will see those like Endeavor or Acumen, who are nonprofit organizations that go to their donors. Venture for America is another one. They go to donors to donate C3 money that they're not going to get back, and then they use that for investments into for-profit companies. And that is meant to be an evergreen fund that supports the mission of the nonprofit. So that's one category. For the mission first, I think there are some that are organized as for-profit VCs, and I've heard of some that have raised from foundations, for example, or individuals. I think for the impact and profit sort of dual category, I think most venture funds, I think you start out with high net worth individuals, family offices, and then as a track record is established, you can tap into LPs. Those most established in that category have a great track record of financial returns, which attracts LPs that are interested in that purely on that basis and are able to underwrite it. There often can be, like in university endowments, for example, there can be people working there who personally are attracted to and believe in the mission. Their explicit mandate from their employer is to find financial returns. And so they have to communicate internally about the financial returns with kind of an aside or a cherry on top is these impact benefits. And if you are able to build that track record, then you can tap into those kinds of traditional institutional LPs, pension funds, and others.
But you would say that having the mission can help you get that internal champion at the LP organization?
Yes.
Yeah. Wonderful. All right. Next question coming from Anand. What has been the impact, positive or negative, of first, the decline in the world economy due to COVID, and second, the increased awareness of diversity, equity, and inclusion on the availability of funding for social entrepreneurs?
Yeah, this is such a broad question. So in the first one, the decline in the world economy, there's been a shift of activity towards digital, and in certain sectors, a real leap forward in adoption in education, in healthcare, in others, in a digital life. And for those who are investing in change, those who are investing in technology and digital applications, that can mean growth, as hard as the transition may be on some people. And though many people have lost jobs, there are opportunities in that transition. And so that's one of the positive impacts that you've talked about. I mean, I am certainly not an expert on all of the negative impacts of the layoffs in other sectors like restaurants and hospitality, et cetera. And you read about it in the paper, and it's really scary to think what's going to happen. So many people unable to pay rent or to afford other things. So I don't think I'm an expert on that, but certainly watching that carefully. In terms of equity and inclusion, you haven't seen the numbers shift that much. There's been a public conversation about the venture capital industry and the people making the decisions of investing. You haven't seen a huge shift in the existing funds. It takes a long time to vet and bring on partners. You've seen some high profile funds hiring additional partners to attempt to diversify. So you've seen some things around the margin, but All Raise is one organization that tracks particularly female GPs, and they've shown some movement, but I would not say dramatic yet. You know, a lot of conversation this year about Black Lives Matter movement moving to center stage for a while. And again, I think you saw investors talking, making some investments, but I wouldn't say a huge shift in the numbers yet. So something that I'm hopeful about, but hard to say that, you know, concrete, tangible change has happened already. I think that one thing you are seeing that is encouraging to me, and I don't have specific numbers on this, but I do see more, again, this speaking of like venture capital industry, I do see more efforts towards emerging managers, and I'm hopeful that the dollars will follow. And so this is the lingo for new managers, new VCs raising funds, and for women and for underrepresented GPs. Unfortunately, or fortunately, depending on your perspective, the path for many have been to create their own firms, and you're seeing that at record rates. And so, as those firms build a track record, I'm hopeful they'll be able to raise additional institutional capital at more scale, which will move the needle, I'm hoping.
Yeah. Has your personal investment thesis changed with COVID?
We have focused Purposeful Ventures on helping, you know, invest in companies and work with entrepreneurs that are mission driven, in companies that make people healthier or wealthier. And so the digital shift that we've seen with COVID in the healthcare industry has certainly been a tailwind and strengthened the value proposition for a number of the healthcare investments that I've made. And it certainly underscored the need to broaden financial inclusion. So I think it strengthens the thesis and changes it a little bit about around the edges, but has not changed the focus.
Yeah. All right. Next question from the audience. Similar to another question, what are the performance indicators for purpose companies? Are there resources, blocks, etc.? Where VCs share thoughts on this measurement in the impact space?
Yeah, this is an area that I think needs further work, right? There's a number of frameworks for measuring impact, and we don't have the same emphasis as a business community on those impact frameworks as we do in financial metrics. Those financial metrics, we spend a lot of time developing the standards, and there's a broad effort to develop GAAP, right? To develop the international financial reporting frameworks and to harmonize the two. It's constantly evolving. And there's a similar effort, which I'm not an expert in, there's a similar effort in impact measurement. The problem is that there's more competing standards rather than one that is well established and embraced by all. I found that impact-oriented VC funds tend to focus on measuring fewer tangible outcomes that they can realistically expect to get from their portfolio companies. So when it comes down to the practicality of it, I found often that it's, you know, how many of our portfolio companies, you know, how many jobs are being created that are quote unquote like good jobs, right? They'll have some definition around what the wage is, the amount of benefits, and then measure how many portfolio companies, you know, are creating how many of those jobs. You'll often see a measurement, you know, somewhere around carbon emissions. You'll see attempting to measure number of people served, but you often run into a challenge of, you know, sort of the depth or quality of change in someone's life versus some, you know, number served. And so combining, you know, across a whole portfolio about how much change is being done when you're comparing, you know, an ed tech company that's educating some people versus a health tech company that's in the background to doctors healing people. It's hard to compare those two and aggregate them.
Are there any metrics that you track for your fund and maybe even report to your LPs?
So we're still evolving on this, and we're on the basic end of this. I track demographics about the founding team, really wanting to avoid the biases that the typical investment community falls into. I also find it's a way to broaden the lens of types of problems that are being addressed when you're making sure to talk with, consider, and invest in all kinds of entrepreneurs from different backgrounds. The other thing that we track is around number of people who are employed, directly, and I closely track the success of the organization, which in some ways is a financial metric, but I also consider an impact metric, in that we're investing so early that some of these look indistinguishable from ideas, and it's important how much capital they're raising behind it, and how much revenue they're getting to show that these organizations become real companies that grow into the future.
Yeah, very interesting. And is there, from your LP base, are they looking for a specific metric? Is there a question on the impact that you're fielding from them repeatedly?
What I hear mainly from my LPs is wanting to understand the sector focus, and the approach that we've taken at Purpose Built is working with mission-driven founders who have a real passion for making change, positive change in the world, helping them build that into their culture so that when they raise additional capital or work with traditional venture capitalists, that is seen as a bonus and an improved part of the value proposition. And we're focused on particular sectors that we believe will cause positive change in the world. So that's what the LPs want to understand, is sort of that process, and know that given that we're a minority investor at an early stage, our influence, down to the level of particular impact metrics is going to be limited.
Yeah. Right, and moving on to the next question from the audience. Harpreet is asking, what are some of the common issues you see pre-seed impact entrepreneurs facing? What advice do you have on those issues?
I think many of the issues that you'll see are similar to all founders. I think issues that would be unique is this real sense of doubt about how much to talk about the mission and how important that is, and sort of how to communicate about business and impact. You even hear some people give advice or question, like, should I have two versions of my deck, right? Should I communicate differently to different audiences? And I certainly think that you should respond to questions and respond to the situation you're in, but I definitely don't encourage people to have two decks. I mean, you want to be authentic about who you are and communicating clearly about what your company is. I think that impact entrepreneurs will sometimes, avoid, like all entrepreneurs, will avoid getting really clear with themselves and their co-founders and their team about what the goals are. So that's just something that I continually beat the drum about, is know what you want to accomplish. Is your orientation towards maintaining control? Is your orientation about maximizing impact, regardless of the form of the organization? Why are you starting a company versus joining an existing organization? Being really truthful to yourself about all of these things, I think, really informs your strategy and is critically important as you're building relationships with co-founders.
Yeah. So you're, in that sense, you're also asking a lot of questions about the founder's motivation. How much of that thinking should they communicate to an investor that they're looking to for funding, and how much do they need to just really figure out on their own time?
Yeah, I think most of that is work that they need to do themselves and with the co-founders. It does become important for investors. A VC investor is going to be looking for growth and looking for the ability to get their money back. So understanding that an entrepreneur is going to be oriented in the same direction and has similar goals is important, and you want to communicate that in some way. You also want to be able to communicate in some way, and again, this isn't always explicit, but that you're not expecting to maintain 100% control over all the decisions, right? These are things that VC is going to be looking for, because if you form the impression that an entrepreneur wants 100% control and to never sell the company and isn't oriented towards growth, it's not going to be a good investment for a VC model. It may be a good loan, it may be good revenue-based financing, but it's not a fit for the VC model.
Yeah. And maybe related, an audience question from Jessica. Do you have tips for social entrepreneurs that are looking for early stage funding for non-tech social ventures?
Yeah, I think that there is probably less venture capital that's oriented towards explicitly non-tech, but I think the definition of what tech is fairly broad for many VCs investors these days. It's sort of tech-enabled services often means that you have some software as part of the mix, and so I'm not sure these days what counts as non-tech. I mean, it's really affecting a lot of industries. But if you're really looking at completely non-tech, you're probably less likely to attract VC investment. You have the other routes like angel investment, loans from banks or individuals. You have, again, I don't know the scale of capital that you're looking for here. There are opportunities from certain government-backed entities that do make investments or provide other financial support. And I think it's a really interesting area to see what's going on with co-ops. I think there's been a increased level of interest there. I think there's interesting stuff happening with revenue-based financing, and that's been growing as well. So I would certainly look into that.
Okay, and then Jack is asking, any pros and cons for incorporation as a B Corp rather than a C Corp?
Yeah, so this is an area I find a lot of confusion among entrepreneurs and even investors. There are two things that are named in a similar way. So there is a for-benefit corporation, which some people call a B Corp, and there's a certified for-benefit corporation, certified B Corp. Those are two distinct things, and they often get confused. So a for-benefit corporation means that under state law, and there's many US states that support this, including Delaware, you are writing into your charter and selecting a different type of incorporation. So it's very, very similar to a C Corp, for example, in Delaware, that almost all public companies are and VC-backed companies are. The difference is that you're writing into your charter a public purpose, and you are, in theory, opening yourself up to liability that one of your shareholders, I think it's a threshold of 2%, can sue to enforce the purpose and the mission that you have. Those are the two main differences. Otherwise, it's like a corporation that you're used to. Then there's also the certified B Corps, which is run by the nonprofit B Lab. If you want to know more about this, I interviewed Bart Houlihan, who is one of the co-founders of the B Lab, and that's on my podcast, Startups for Good, which you can find at startupsforgood.com, all run together. So I think that the certified B Corp run by B Lab doesn't work that well for early stage, from scratch startups. I think it's an interesting list of items to look at, and you can aim towards getting the certification, but the certification requires a backward-looking perspective on what are you actually doing. And if you don't have operations, it's hard to say what you've done because it's still, you hope to do, it's still plans. But they do have a designation, which I don't see used very often. I mean, maybe others do. I'd be open to input. It's like, I think it's pending certification or something like that, which is meant to signal that you're headed in that direction. I haven't seen too many people do that. I have seen a number of founders, choose to incorporate from the beginning as a for-benefit corporation, a B Corp, under Delaware law. And I have not seen significant downsides to that. There is, I think people believe, some signaling risk that traditional VC may not have appetite, but I have seen, the biggest name VCs that are, considered the most, profit-oriented. All the top names in VC, almost all of them, I've seen invest in these for-benefit corporations. So if the business is doing well, it is not a reason that people will stay away.
Okay, great.
And
So
I think it's a very strong signal on the upside. I should say, I think it's a very strong signal to certain class of customers and to employees. And I think it's a great way to show your commitment, and it strengthens your hand in the future if you're ever worried about bringing in financial investors who may have a different perspective at certain key points about choices. And it strengthens your hand to say, look, it's in the charter, this is what we're doing. And so I definitely recommend it. I'm a big fan of the for-benefit corporation.
And a related question, I'm not sure if this has happened in your portfolio or the founders that you've worked with, where they took on funding from an impact VC, and then at one point along the life of the company, they decided to pivot away from their original mission and were maybe more oriented to a financial benefit, or just something that was not as in line with the social impact early funding that they took on board. Have you encountered that conflict?
I don't think I've seen exactly that scenario. I've been an investor only a few years, so maybe that's coming in the future. It's certainly possible. Part of what the value that Purpose-Built Ventures adds is being a companion to that founder to, continue focusing on that mission, on that journey to achieve that purpose goal. Say don't give up on that. And I haven't really seen founders who are wanting to do that. We certainly had pivots in business model and product, and I think that's normal. But that hasn't turned people away from the mission.
Okay, yeah, fantastic. Okay, question from Fadi. And this is a more detailed one. What are the requirements for impact capital on predictable profitability, predictable revenue, some revenue, or no revenue? Any ideas?
Yeah, I'm not sure I understand the question fully. So is this a question about what is the criteria in order to raise money at different stages?
Yeah, I think it's the criteria for raising money from impact capital, and do the same criteria in terms of profitability and revenue apply if you are a mission-driven founder?
Yeah, I think, to some extent, this sounds like
So
these
I
are
think
different
how I
stages.
read it, the
Yeah.
question is, what's a minimum stage you have to be to get impact capital? Can you
Yeah.
raise on ideas only, no revenue early stage, or some revenue early stage, or you have to be
Right.
predictable revenue or profitable before you
This
can
is a
raise?
great question to ask any investor that you're talking with, or great question to try to determine from their public materials, because each investor will have a different threshold for what they're looking for. There are certainly those, they're more likely to be angels or those that you've worked with in the past who will invest in pure idea. If you have a background of success in the industry in which you're working, or if you've had previous success with ventures, you can raise on idea. for example, purpose-built ventures, we are interested in investing when you have either built something or sold something. And I think most investors at the earliest stages, do want to see the beginning of a team, do want to see some sense that there's demand from customers, even if it's not, dollars exchanged yet, depending on the industry, like at least letter of intent or some indication of interest from customers, and at least some version of a product, early prototype, MVP, something. Again, these all depend on the industry and how complicated it is to build a full product. If you're in the software industry, more and more these days, the reaction is like, why don't you just build it, right? Like start building, and it's not as expensive to build software as it once was. You're not going to build out the whole thing. In some industries, you may not be able to get that close to a final product, but you can show paper, work of what developed out, what is coming. You can show that customers are demanding it. You can show that you have the suppliers lined up, et cetera, et cetera. So I think the exact answer is going to depend on which investor you speak with.
Yeah, perfect. Next question from Jason. Ooh, it moved. Impact obviously benefits a great deal through public sector collaboration at local, state, national stage. What are thoughts, experiences, advice, or best practices with public-private partnerships to foster impact ventures? Also, have you pursued or engaged at all in the opportunities that I don't know what the opportunity zones?
Yeah,
I would love to
opportunity
hear.
zones is a federal designation that provides certain tax benefits for real estate investment or companies that have a majority of their employees and I think their headquarters in certain geographical areas that are designated in need of investment and economic activity. I think the states nominate them and then the federal government has approved them. It's only a few years old. There have been similar programs in the past. Some have worked and some haven't. I think for opportunity zones, it's not something that I have spent a lot of time looking into, although I do know investors who do focus on it. And I have not made investments on the basis that they were in opportunity zones. They probably have some investments in opportunity zones, but I don't even know exactly which ones. So that's opportunity zones. On the public-private partnerships, again, I would say I don't have a ton of experience. My second company was SeeClickFix. We sold to primarily local governments, also state level. And I'm not sure that's exactly what you're talking about. This was more of a vendor partnership where they were buying software and services. But maybe you could elaborate a little bit more on what kind of public-private partnerships you're thinking of there. Like buildings, infrastructure?
I'm not sure, Jason, if you can elaborate more and put it in the Q&A, I can read it out. But I guess from your experience with those partnerships with local governments, what are some best practices in having those partnerships run successfully?
I think the core of it is like any customer relationship. You want to be responsive and focused on their needs, and they need to trust you. The differences in the local government space, compared to selling to a business, for example, is the cycle of turnover of leadership, or at least like the election where there's a potential for turnover, can mean that there's a regular shift in strategy, which is on a different rhythm than you see in businesses. Businesses shift strategy, but it's not on that kind of predictable election cycle. I think you also see, you see this in the largest companies, but it's more common, I would say, in local government to have, really explicit different constituencies. So, someone working in this department may just straight up tell you that they just don't care what the public needs, or like what the mayor says, or what the citizens want. Like this is my objective in my department, is to have my own kingdom, and et cetera, et cetera. So you get some really different objectives that people can be surprisingly upfront about, which can be tough to navigate. But if you're going in eyes wide open, you have a better chance with that.
And then a more general question where we can draw from your experience both as a founder and an investor. What are the best practices for founders when fundraising and going through due diligence? Maybe just top 3 or top 2
Yeah.
tips.
Well, I think for fundraising, I think that keeping the perspective that it's a matching problem rather than framing it as like, am I good enough? It's not like you're trying to get over some hurdle. It's more that you're trying to find the right investor for you. And that, I think, can encourage you to keep going and to take the approach that I believe is best is really, as a founder, when you're fundraising, you got to talk to a lot of investors, and you got to consider talking to a lot of investors. And it's a real numbers game, similar to the way sales is. And I would really encourage people to think about it that way. I recently hosted a fireside chat for an entrepreneur who raised, successfully sold a number of companies and raised 150 million for his last company from top tier VCs over multiple rounds. Someone that I personally consider the best fundraiser I've ever been around personally. And he told this group that he talked to dozens and dozens, hundreds of investors for each round. And he put a lot of work into his materials and into constantly refining his pitch. And so, that had a big effect on me to hear someone who I thought was so talented at fundraising really explicitly say that even so, it takes lots of practice and you have to talk to a lot of people. So I think keeping that in mind is really important. On the due diligence side, I think get yourself a list of the common due diligence questions that are asked. Particularly, as I said, like getting to Series A, people tend to get more serious about due diligence, and be aware of what's coming. You can have, if your point on fundraising, it often can be for someone else on the team to start putting together all of the materials, sort of the legal contracts, the proof of equity grants, the other types of foundational documents, your previous financials, et cetera, and organizing them into a folder can be helpful. So that's like real due diligence, I would say, post-decision. Sometimes people call due diligence, they're also in that fuzzy middle where they haven't really fully made the decision yet. And I would consider those materials to be really part of your fundraising process. And so that I would put in a separate category, and I would prepare those also. But the person whose point on fundraising should be right in the thick of that. So things I would put in that category are not sort of the legal contracts, checking things, but more, what are, for a consumer, what are your cohorts doing? What's the retention? What's the customer acquisition cost? What are your, financial projections going forward? Those kinds of things that are going to give an investor a sense of how the company is doing, would be in that category of fundraising materials.
Yeah, wonderful. I think we're almost at the top of the hour. So I want to thank you, Miles, for taking the time to talk to us. I want to thank the audience for your fantastic questions. Sayuri, any last closing words?
No, again, sincere thanks to Miles. And I have put in chat the venturepatterns.com. So everybody, if you have additional questions, maybe you want to go there. And also the podcast, startupforgood.com. And this was a great session, Miles. And anybody else that want to continue this discussion, please go to our community platform and we can continue this discussion. And if we have some more specific question, we can invite Miles to answer them for us.
Yeah, great. And people can also email me, miles@purposebuilt.vc.
Thank you so much.
Thank
and
you.
See you guys next time.
Thank you. Take care.
Bye.
Thanks for joining us. And for more information on how to connect with the MIT Alumni Association, please visit our website.